Baseball lockout is done, but you're here for accounting and auditing. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the partner in charge of accounting and auditing at Sobel & Company. These episodes qualify for nano credits. If you're interested in earning CPE credit for this and other episodes, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily of the NJCPA or Sobel & Company. Okay. So we have a fairly light agenda today. There has not been a lot of information that's come out over the past couple weeks. It seems that they've gotten into a little bit of a lull. Maybe they're respecting the busy season for those that are in public. But I do have a couple topics I want to bring up. Some of it's going to be updates and reminders. I will say that the FASB still has been having their meetings. And interestingly, at the past couple meetings, they've been going over goodwill and certain elements and how they should be treated and combined with other intangibles. So they seem to be reviewing this a lot. And if you remember, FAS 141 and 142 came out where they discussed goodwill and addressed it toward business combinations. And I'm just very surprised that they're still going over this after all these years. Now, one of the things I wanted to bring up and remind people that back around 10 years ago, it was around 8 years ago, 2014 or 15, the FASB came out with an ASU that says those are in private, that are private companies can amortize their goodwill. Now, if you have not been amortizing your goodwill, you're crazy. Now, that's an editorial comment, but I still think you're crazy. Because at this point, it was 8 years ago, you could amortize it for a period not to exceed 10 years. You would have had this pretty much written down at this point. And the reason why I'm concerned about it is because people forget a lot of times that you still have to review goodwill for impairment, even if you've been amortizing it. And if you haven't been amortizing it, you have a larger asset that you could potentially have to consider for impairment. Now, we've just gone through 2 years of COVID and shutdowns and business interruptions, and now we have supply chain concerns. There's a lot of issues as it relates to different issues that could bring up indicators for impairment. And I'm going to talk about going concern a little bit, and that's another topic too, but you always have to consider impairment of goodwill and other long-lived assets. If you haven't considered this and looked into it and think about what the indicators are, you should look into the old FAS 121. I know I'm going back on the old references, but I don't know the ASC off the top of my head. I had it and I forgot it just now. But otherwise, you can reach out to me. I did a presentation on it for the society a while ago. I'll be happy to share it with you and talk with you about it. But if you have the indicators, and one of the big ones is recurring losses, then you should really start considering reviewing long-lived assets and goodwill for impairment. Okay, recently issued accounting pronouncements. Now, I'm not saying what we're going to go over any recently issued accounting pronouncements. I'm talking about disclosing recently issued accounting pronouncements. Now, you know that I do a lot of peer reviews. Frank Boudelet, he's been doing them, but he's retired now, so I don't know if he's going to be doing that much anymore. Public companies have to disclose recently issued accounting pronouncements. Now, they're accounting pronouncements that relate to that entity that they're in. So if it's a biotech industry and something comes out on employee benefit plan reporting, then it may not be applicable to them, so you would not put that in there. Private companies should also disclose recently issued accounting pronouncements if they potentially have a material effect on the financial statements. So over the past couple of years, companies should have been disclosing revenue recognition before that became effective. The lease consideration, especially if you have leases, you should be disclosing that there is this pronouncement out there and at least that the company is evaluating it. And the last one that you should probably consider is CECL. That's current expected credit losses. It's not effective until fiscal years beginning after December 15, 22. So that is calendar year 23. But you should at least disclose that these accounting pronouncements are out there and that they may have an effect on the financial statements, but management is evaluating them. Because they are significant pronouncements, especially the leases, if you have leases. So a question came up when Frank and I were doing a seminar, particularly as it relates to leases and the accounting for leases. I'm not going to go over that whole thing now, and some of the other big pronouncements that came out. And somebody said, does it matter if I'm doing a review or an audit? No, it doesn't matter if you're doing a review or an audit. If you're doing financial statements in conformance with GAAP, you should have the same disclosure if it's a review, an audit, or a compilation with disclosures. GAAP is GAAP regardless of the report that's being issued by the accountant, auditor/accountant. Okay? The last one is tax versus GAAP. I had a comment made in my office the other day that somebody said, well, we don't have to disclose that because it's tax basis financial statements. There are certain pronouncements that generally transcend GAAP and tax or ACBOA or special purpose type of reporting. There are pronouncements and guidance that generally transcend it. Okay, commitments, contingencies, those type of things would transcend and go across a broad spectrum of frameworks of accounting. Now, revenue recognition in 606, that just applies to GAAP. That's different. So you really need to analyze it. But just giving this broad comment, I'm saying, oh, it doesn't matter, they're tax basis financial statements. You got to be very careful with that type of comment. Last one on the FASB area that I want to bring up, and if you notice I'm bringing up stuff is because this is what you should be considering when you're preparing your financial statements if you haven't already issued your financial statements for 2021. Going concern. Going concern ASU 2014-15, as you can see, came out almost 8 years ago. And what that did was it took the responsibility of going concern off of the auditor and put it onto management. Going concern is an assertion that's made about the financial statements that that your company is a going concern, which means you will continue, and we'll talk about the period that you will be able to continue. It is management's responsibility. I just had a discussion about this yesterday with a client, explaining to them that this is the assertion that they're making. I have to audit their assertion. Remember, if there are some indicators of potential for going concern, recurring losses, I, as a QC person, focus generally on 4 items on the surface, just 4 items on the surface, okay? The 4 are negative capital, negative net worth, losses or recurring losses, negative working capital, and also negative cash flow from operations. I see any of those 4 in the financial statements, I say, do we have to consider it? I'm not saying it's automatic, but it just comes to light to me. There are other indicators, work stoppages, legal actions, COVID or environmental issues. There are other indicators. So if you're part of management, you have these, you have to start considering and evaluating going concern. What's the period that you have to evaluate if you have the ability to continue? Remember, it used to be a year from the balance sheet date. That stopped when it came under ASU 2014-15, and it's 1 year from the date the financial statements are issued or available to be issued. That was a big change too. If you feel that you can alleviate it, you still have disclosures that have to be made. So long as you have indicators, you have to have the disclosures. And then there's reporting that's required by the auditors, the accountants/review, and possibly for a compilation. We'll go over one more area because I'm just watching the time. The Government Audit Quality Center of the AICPA came out with some guidance for provider relief fund programs. What does that mean? So the Department of Health and Human Services provided some corona relief funding to for-profit healthcare entities. Okay, so you're saying, well, what is this all about? Well, if your client, receive funding from Department of Health and Human Services for corona relief funding, you could be subject to a single audit. Now that's big because if you received over $750,000, you may have a different amount of reporting and a different audit that has to be performed. So please, if you have clients that are for-profit healthcare entities, or if you work for a for-profit healthcare entity and you receive funding from Department of Health and Human Services under the Coronavirus Relief Fund, you could be subject to it, and watch out for this. And the AICPA does have some good guidance on that. So if you're not a member of the AICPA, there's a reason that you should join, because they actually had a good handout, an AICPA checklist tool for auditors taking on single audits. So just think about that. Okay, so I had a couple of topics and we'll cover them next time, so that hopefully you come back to see them. But let's just say, in closing, I'd like to remind you about some NJCPA events. On April 25th, Renee Rampula will be presenting on FASB Update webinar. She always does a great job, and it's good to see her coming back now. On April 27th, she'll also be presenting on Private Company Financial Statement Disclosure webinar. On April 26th, the Bergen chapter will be holding an in-person A&A update on revenue recognition and SARS. And on April 29th, the Southwest chapter will be holding an in-person, it's like Crazy Eddie, they're insane, in-person A&A update on leases. Register for these events and more at njcpa.org/events. Lastly, I recommend that you join the NJCPA Accounting and Auditing Standards Interest Group by going to njcpa.org/groups. Thank you for joining us.